This man ran a company that Fortune magazine named the most innovative in America. Not once, 6 years in a row. 24 days after it last looked invincible, that same company filed the largest bankruptcy in the history of the United States. It's not an exaggeration for a thumbnail. On August 23, 2000, Enron stock hit $90.75 a share, a company worth around $70 billion, the seventh largest in America. 16 months later, it was worth almost nothing. 20,000 people lost their jobs. More than $1 billion of employees' retirement savings evaporated, and the most respected accounting firm on earth was destroyed alongside it. Here's the question. This whole video answers. How does a company worth $70 billion vanish in a matter of months? And did the smartest guys in the room know all along? I'll tell you the answer right now, because the system doesn't hide the ball. Enron was not an energy company that failed. It was an accounting illusion that finally ran out of road. The one thing Enron truly innovated was not a way to move gas or electricity. It was a way to book profits it had only imagined, and to hide its real losses inside companies it secretly controlled. The entire machine was propped up by one thing: its own rising stock price. That's the what. The reason this is one of the greatest business stories ever told is the how. How they did it in plain sight, who tried to warn everyone, and who actually paid when it fell. So let's get into it. It started, like a lot of empires, with a merger. In 1985, two pipeline companies combined, and a Missouri preacher's son named Kenneth Lay became head of the new giant. He named it Enron. Lay did not want to run a boring pipeline company. He wanted something modern. So in 1990, he hired a brilliant, restless McKinsey consultant named Jeffrey Skilling. And Skilling had a genuinely radical idea. And I want to be fair here, because this is the part everyone skips. Skilling's idea was smart. What if Enron didn't have to own the pipelines and power plants at all? What if it became a kind of stock market for energy? Buying and selling contracts for gas and electricity like a Wall Street trading desk? Asset light, fast, modern. Honestly, you have to give the guy credit. It was a brilliant idea. The trouble was, the one accounting trick Skilling needed to make it look as good on paper as it sounded on stage. Let me show you that trick, because it is the whole ballgame. It's called mark-to-market accounting. So meet a power plant, one Enron hasn't built yet. Enron signs a 20-year deal to sell the energy from it. Now, normally, you'd record that profit as the cash actually arrives, a little each year, for 20 years. But under mark-to-market, Enron was allowed to estimate the total profit across all 20 years and book every penny of it today, as if the money were already in the bank. The SEC approved this for Enron's trading business back in 1992, and it quietly turned the company's accounting into fiction. Enron could announce enormous profits while the real cash never showed up, because the profit was a guess about money it might collect years later. As long as the stock kept rising, nobody asked where the cash actually was. But a profit you've only imagined still has to come from somewhere. And when it doesn't show up, you have to put the hole somewhere. Remember that. We're going to meet the man whose entire job was hiding the hole. His name was Andrew Fastow, and he was Enron's chief financial officer. To keep the illusion alive, Fastow built a maze of secret companies with strange code names: Chuco, LJM, and a set of 4 he named, with a straight face, after the dinosaurs in Jurassic Park, the Raptors. On paper, these were independent businesses. In reality, Fastow ran them himself, while he was still Enron's CFO. Enron's own board waived its conflict of interest rules to let him do it. He used these shells to move more than $1 billion of debt off Enron's books, and to quietly pay himself tens of millions on the side. Here is the fatal flaw. These hidden partnerships were propped up with Enron's own stock, which means the whole scheme only worked while the stock went up. If it ever fell, the hidden structure would collapse and drag the real company down with it. Enron had built a financial machine that could only move forward. There was no reverse. But before the fall, there was the greed, and it had real victims. In 2000 and 2001, California deregulated its electricity market, and Enron's traders saw an opening. They built strategies to game the grid with nicknames like Death Star, Get Shorty, and Fat Boy. They shoved power around, manufactured shortages, and drove prices through the roof. The result was rolling blackouts across California. And on their own recorded phone lines, Enron traders can be heard laughing about it, joking about taking money from a grandmother they nicknamed Grandma Millie. California's power costs exploded by tens of billions of dollars. Enron made a fortune. So yeah, that's who we're dealing with. Then, in March 2001, a reporter at Fortune named Bethany McLean published a short article with a dangerous question for a title. Is Enron overpriced? It wasn't even an accusation. It was simpler than that. She just asked the one thing no one could answer. How exactly does Enron make its money? She'd been tipped off by a short seller named Jim Chanos, who'd read the filings and couldn't make the numbers add up. The emperor had no clothes. People were just afraid to say it out loud. Then the mask slipped in public. On an earnings call in April 2001, an analyst asked Jeff Skilling a completely normal question. Basically, can we see a balance sheet? Just show us the numbers. And Skilling, the CEO of the most admired company in America, lost his temper and called him a single word you are not allowed to say on a live earnings call. It's on the tape. If you want to know the exact second the most innovative company in America stopped pretending, it's right here. Timestamp it in the comments. Then came the move nobody could explain. On August 14, 2001, after just 6 months as chief executive, Jeff Skilling abruptly resigned. He cited personal reasons. Why would the man who built the modern Enron walk away from a company he swore was thriving? People inside were starting to wonder the same thing. One of them was a vice president named Sharon Watkins. That same month, she wrote a memo to Ken Lay with a chilling line that the company could, quote, implode in a wave of accounting scandals. She was right. She had about 10 weeks to wait. On October 16, 2001, Enron reported a $618 million loss for a single quarter, and separately revealed a $1.2 billion hit to shareholder equity, tied to Fastow's hidden partnerships finally unwinding. 6 days later, the SEC opened an inquiry. Fastow was fired. Then Enron was forced to admit it had overstated its profits for years. The stock went into freefall. A rival named Dynagi agreed to buy Enron, looked at the actual books, and backed out. The credit agencies cut Enron to junk. On December 2, 2001, Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in American history. The next morning, thousands of employees were told to grab a box, clear their desk, and be gone within the hour. And this is who actually paid. Enron had encouraged its own employees to load their retirement savings, their 401ks, with Enron stock. When the company collapsed, that stock became worthless. Engineers, assistants, line workers, ordinary people watched their entire life savings vanish in weeks. More than $1 billion of employee retirement money gone. Meanwhile, at the top, the story was different. One executive, a man named Lou Pai, had quietly sold his stock before the collapse and walked away with more than $250 million. He was never criminally charged. The wreckage spread outward. Enron's auditor, Arthur Andersen, one of the most respected accounting firms in the world, was caught destroying Enron documents by the ton. It was convicted of obstruction of justice and effectively wiped out, taking tens of thousands of its own employees down with it. And here's a detail almost everyone forgets. 4 years later, in 2005, the Supreme Court of the United States unanimously reversed that conviction, ruling the jury was given the wrong instructions. It came far too late. The firm was already dead. A reminder that convicted and guilty forever are not the same word. There was also a quieter tragedy. In January 2002, a former Enron vice chairman named Cliff Baxter, who had argued internally against the hidden partnerships and was expected to testify, was found dead in his car. It was ruled a suicide. We're not going to speculate beyond that, because the record doesn't support it, and a real person died. The leaders went on trial in 2006. After 56 days, the verdicts landed. Jeffrey Skilling, guilty, 19 counts. Kenneth Lay, guilty, every count against him. But Ken Lay never spent a day in prison. Weeks after the verdict, before he could be sentenced, he died of a heart attack. And under the law, because he died before his appeal could be heard, his conviction was vacated, erased, as if it had never happened. So be precise about it. Ken Lay was convicted by a jury, but he is not in the eyes of the law a convicted man. Jeffrey Skilling was sentenced to 24 years. He'd ultimately serve about 12. Andrew Fastow, the architect of the hidden companies, cooperated with prosecutors and served 6. And out of the rubble came one lasting thing, a law called Sarbanes-Oxley, written so that executives could never again hide a company this big, for this long, in plain sight. What was Enron, really? After the imaginary profits, after the dinosaur partnerships, after Grandma Millie, after the word you can't say on an earnings call, after the shredded documents and the $250 million quiet exit, what's left is simple. Enron became worth $70 billion while owning almost nothing real. It ran on an accounting trick, propped up by its own stock price, steered by men who were absolutely certain they were the smartest guys in the room. The tilted, crooked E sign outside their headquarters turned out to be the most honest thing about the whole company. And if the shape of this story feels familiar, it should. A dazzling company, nobody fully understood. Profits that never matched the cash. Insiders cashing out while everyone else was told to keep believing. It's the same shape as WorldCom, which fell the very next year, the very same way. The same shape as Wirecard, the same shape as FTX. The tools change every time. The trick never does. Make the losses disappear, and pray nobody asks where the money went. So I'll leave it with you. Were the men who built Enron visionaries who crossed the line, or con men who happened to have a vision? Tell me which in the comments. I read them. The story of Enron, the smartest guys in the room, and the $70 billion illusion they built. If you want to watch this exact pattern play out again,